Hi guys, Lucca here, the market logician. Most investors chase the big names, the Magnificent Seven, TSMC, Palantir, but the real opportunities often hide in the shadows. And that's where Opera comes in. After restructuring and key changes, the company has entered a highly profitable path with massive growth potential. Its stock could climb as much as 50% in the coming months. But what makes Opera so attractive? Let's find out. Before we get into why Opera is interesting right now, we need to understand how they make money. There are two main engines here. First, advertising inside the browser. Every time you open Opera, you see things like newsfeeds, sponsored shortcuts, or promoted content. Those placements are sold to advertisers, and with hundreds of millions of users, that's a really valuable space. Second, search revenue sharing. Opera has deals with companies like Google and Yandex, and when a user searches through Opera's built-in bar and clicks a sponsored result, Opera takes a share of that revenue. What's interesting is that this model scales naturally. The more people use Opera, the more impressions and more clicks. The more Opera can personalize the experience, the higher the revenue per user. Breaking down the numbers, we see that advertising actually represents the largest share of the business, about 65% of total revenue. The other 35% comes from search partnerships. Now, let's move to the first reason why Opera might be a great Q4 opportunity. The numbers. Revenue has been climbing steadily year after year, and adjusted EBITDA has been expanding too, from about 25 million in 2020 to an expected 138 million by 2025. Margins are improving, which shows the business is scaling efficiently. But here is the key detail. Advertising is the fastest growing part of the business, and that's not by accident. It's directly aligned with Opera's strategy of focusing on higher ARPU markets. Instead of chasing volume everywhere, they've been targeting more profitable users and regions, which has pushed average revenue per user up. We'll take a closer look at this ARPU growth soon, but the takeaway here is simple. Opera is growing and each user is becoming more valuable to the company over time. And looking at the cash flow, the story gets even stronger. Opera's free cash flow has been outpacing operating income, which means this isn't just accounting profits, it's real money coming in. Back in 2021, free cash flow margin was only about 6%. Today, it's over 16% on a trailing 12-month basis. That's a huge improvement, and it shows the business is running much more efficiently. So, Opera isn't just growing revenue, it's turning more of that money into real cash. Cash they can use to reinvest, pay dividends, or just to keep the balance sheet strong. The second reason to pay attention to Opera, their product strategy. On desktop, they are not competing directly with giants like Chrome and Safari by trying to be everything for everyone. Instead, they've launched niche browsers. Standard Opera for PC and mobile, the classic version with an ad blocker and VPN, Opera GX on PC and mobile, made for gamers, Opera One on desktop, the AI-ready flagship, Opera Air on desktop, clean and minimal. Each one targets a different audience, which helps Opera reach more users and monetize better. 1996, first to introduce tabs. 2000, first with built-in web search. 2002, first full web browser on smartphones. 2006, first to sync PC and mobile. 2015, first with a native ad blocker. 2016, first with a browser VPN. 2019, first browser for gamers. 2023, first with a native AI. This timeline suggests Opera has consistently kept up with innovation. And in the tech market, that ability isn't optional. It's what allows a company to be competitive. Reason 4. Promising strategies with a proven track record. Opera's revenue ultimately depends on advertising volumes, and that comes down to how attractive the user base is for advertisers. Back in 2020, the company made a key strategic decision. Instead of chasing growth in Africa and Asia, where purchasing power is lower and ad monetization is weak, they shifted focus to Western markets. They cut marketing in those low-value regions, launched products tailored for Western users, like Opera GX for gamers, and focused on building an audience that advertisers are willing to pay more to reach. And it worked. From 2020 to today, Opera grew its audience in Western markets by 27%, while GX browsers users expanded by over 200%. At the same time, annualized ARPU more than tripled, going from just 64 cents to almost $2. This map shows exactly why that strategy matters. In Western markets, the USA, Canada, Europe, Australia, advertisers spend far more per user. That means every new Opera user in these regions is worth much more than one in low income markets. And the numbers prove the impact. From 2020 to 2025, Opera delivered an impressive CAGR of almost 30% in revenue growth. That basically means the company nearly tripled its operation, largely thanks to ARPU, which also tripled in the same period. And the most striking part, this happened even though total monthly active users actually fell from about 308 million in Q4 2020 to 296 million in Q4 2024. So Opera grew by focusing on more valuable users, not just by adding more users. Before moving on, let's look at how Opera actually performed in the first 2 quarters of 2025. The company beat its sound aggressive guidance on both revenue and adjusted EBITDA. It's interesting to note that adjusted EBITDA is growing faster than revenue. That shows Opera didn't just expand sales, it also became more profitable than expected. Reason 6. Following the rule of 40. To wrap up the reasons topic, here is something very interesting. Opera has consistently met the rule of 40. Just to recap, the rule of 40 is the idea that if you add a company's revenue growth to its profit margin, the result should be above 40. That's considered the benchmark for a healthy tech company. And about Opera? Since implementing its reforms, it has passed the rule of 40 for 17 consecutive quarters. That consistency is remarkable, and it shows that Opera isn't just growing, it's doing so in a sustainable and profitable way. To wrap things up, I built a discounted cash flow model to estimate Opera's fair value. In the first 3 years, I used a Wall Street analyst forecast from Market Screener, which show an average growth rate of 20.6%. After that, I modeled a transition period with an average growth rate of 12.2% for the following 3 years. Beyond that, I brought growth down to 3%, which matches to long-term GDP expectation, a standard assumption in discounted cash flow models. Calculating the cost of equity, I applied the CAPM formula with a beta of 0.96 and a market risk premium of 6%. That gave us a cost of equity of about 10.15%. From there, I arrived at a WACC of 10.11%, which I used to discount future cash flows. Putting it all together, the business value comes out to roughly $2.3 billion. Adjusting for non-operating assets and debt, the equity value is closer to $2.7 billion, giving us a fair value around $30 per share. Compared to today's price of $20.50, Opera looks significantly undervalued by around 50%. Of course, this depends on the assumptions, especially future cash flow growth, but based on everything we've seen in this analysis, that growth appears realistic. Summarizing, Opera has a good financial performance, good use of technology innovations, well-positioned products, strategy aligned with reality and delivering results, a very good connection between product, innovation, and strategy, and finally, an attractive valuation with really growth potential. So with all these points, I'd say I recommend... Just kidding. Technically, I can't recommend a stock. I'm just a market logician. But the facts and my perspective are on the table. You decide. Just make sure it's your decision and your risk. If you found this breakdown valuable, please make sure to hit the like button, subscribe to the channel, and turn on notifications. This level of research takes a huge amount of time, but it's all here to help you invest with logic, not hype. Thanks for watching, and I will see you in the next one.